The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Let's talk about what's happening in the cattle markets. And during CattleCon 25, Lance Zimmerman, senior analyst of animal protein at Rabobank, had a new paper to discuss with folks, looking at the outlook here for the U.S. beef industry as we're moving into 2025. Let's discuss that with him right now here on the program. Lance joins us here. It's good to catch up with you again. Thanks for the time, my friend. Hope all is well.
Yeah, thanks, Jesse. Good to be on the other side of the chaos around cattle industry convention and settled into a little bit more of a groove.
Absolutely. Before we get into the deep dive here into your new research paper, what did you hear at CattleCon? I mean, and I think this could set up our conversation pretty well. Is it optimism still? Was there some nervousness with just the way the markets have acted the last, few weeks in certain ways? I mean, what did you hear at CattleCon, Lance?
Yeah, it was funny. While we were there, I think the market was still in its uptrend, right? It's one of those very unique years in that we started out the calendar year with 5 consecutive new record highs in the cattle market. Just a wild time. Usually the calendar year doesn't start with that much optimism. And I think everybody that was there was in some varying degree of the market having scrambled their thought processes on what was going on with the cattle business. And so producers wanted to be euphoric about the opportunity they were seeing to sell into those type of market prices. But obviously then the heartburn starts setting in after the paycheck arrives, because they realize they got to give away a chunk of it just to pay record high prices for the next round of replacements, whether that's in the feed yard or the backgrounding yard, or even the idea of replenishing a cow herd and some of the high replacement heifer prices and bred cow prices we're seeing. And so, as we were going through that, I think the one thing that rang very true is if you were a strict hedger, you were using it as an opportunity to really lock in your profit margins, or better secure them, or put a good floor under your prices through essentially the first half of the year, because the market was offering exceptional profit opportunities all the way out into probably that June contract. Maybe some instances, if they were bought right on the feeder cattle side, to lock in some profits into August. And so I think folks were actively trying to do their due diligence there, and we're thankful for the rally we had. But you're talking about a market where these fed cattle now are valued at $3,000 a head. And the margin opportunity as you look out to the second half of the year and beyond isn't there. It's not being promised by the futures market. So there's also this attitude of concern as we think about what lies ahead. And obviously we know how volatile the markets have been the last several years. And there's certainly the one promise that exists is, well, while maybe we may all disagree on where the price levels are going, everybody's pretty comfortable with the idea that the volatility is going to remain in these markets.
Well, let's talk a little bit more about your research paper, and I just start with the thought comment here of, are we entering a rebuilding phase in this cattle herd? I know that was part of your paper. So, I mean, talk about this, build off what you just mentioned here. I mean, where are we at moving forward in the U.S. beef industry right now?
Yeah, no, I think we can finally sit back with confidence and say we're ushering into the rebuilding phase. 2024, I will classify it as a stabilization year. I kind of look at it as our calendar years as we identify them within the cycle. You have liquidation years, stabilization years, and expansion years. We usually don't stay in a stabilization pattern very long, but 2024 will be classified as that, very much a textbook stabilization year. Yes, the cattle inventory report came out and said the cow herd was essentially 200,000 heads smaller. That's close enough to rounding error to me to call it a stabilization year. And the culling rate, the heifer retention numbers would all be indicative of that. As we look to 2025, it's probably again going to be a stabilization year. We probably will be on the other side of the ledger sheet with a 200,000 head increase if the numbers play out like I think they will. But again, for all intents and purposes, when we look at 2024, 25, or probably the starting inventory that we'll have on 26, they'll all probably be within plus or minus 200,000 head of each other. The good news is we are starting to creep into this idea of retaining some more heifers. You're seeing it in the feeder cattle and calf sales data and the percent heifers in that mix. We just got the print on the January 1% of heifers on feed. We've seen a significant reduction in those numbers, some of the lowest print that we've seen in the last 5 years for that number. And so I think we're leaning into the idea of rebuilding. And as that happens and intensifies, much like it did in 13, 14, 15, 16, and even 17, you're going to draw more cattle out of our available supply. That tighter supply is going to be very price supportive for the next several years. And I think that's an encouragement as we think about the cow-calf segment in particular and trying to figure out how do I afford these animals and how do I make this work for my operation going forward.
Let's talk about the demand piece. We're speaking with Lance Zimmerman from Rabobank, talking about the cattle market. Still plenty of folks concerned about inflation and the overall economy. And you look at the demand side, could that cap some higher price potential possibly here in the cattle markets, Lance?
I think it's a very valid concern. We all tend to have a pretty good understanding of how these cyclical forces can affect supply. We always have a really good way of digesting supply-related information. We know about slaughter and production and trade effects and how that influences all of those numbers. The demand side of the market ledger sheet is always more challenging to get a feel for. But the one thing that I always tell producers is as long as incomes can kind of hold up and keep pace and exceed inflation, demand can still remain strong. All that said, we do know we have a lot of headwinds facing demand right now. Inflationary risks, tariff-related risks. Every single day brings a new amount of chaos and uncertainty around what's going on with the new administration and how is that going to affect things for both production agriculture and just U.S. consumers in general. And so as we look at it for the next several years, we're just going to hold demand steady. We're not going to price in an increase. We're not going to price in a demand decrease because generally speaking, the only time we get demand decreases are when we enter into a recession, right? Recessions largely only happen 2 out of every 10 years. Very few of us in the ag econ field or economist field in general usually make sound bets on predicting recessions. So it's usually best to assume we're not entering one, just be prepared if we do. And then the other side of it, I think that's important to keep in mind is holding demand steady is a little bit of an outlier to recent history because since the demand lows in 1998, demand has actually increased 1.5 percentage points on average each year. And so holding demand steady is somewhat a conservative approach, but it's conservative at really historically strong levels. 2024 demand was the highest we'd seen since 1986. So holding demand steady is still really good demand historically. So you factor that in, plus the idea that we're probably going to see supplies decline on average 3% a year for the next 3 years. That can take prices across the cattle and beef complex to new record highs each and every year, all the way out to 2027. We'll still have seasonal factors at play. We'll still have market corrections, even like the one we just went through over the last handful of weeks. But the general trend is higher highs and higher lows going forward.
Well, as we kind of close out the conversation here today, for the producer, from their perspective, as we're entering this potential rebuild season and we're looking at demand, some headwinds, et cetera, et cetera, how do they manage their risk here? I know you kind of touch on some of that in your report as well. I mean, talk about that aspect for us, Lance.
Yeah, I think the biggest call to action out of the paper that I wrote is this idea that when we think about risk management, we all automatically gravitate towards the traditional price risk management tools, hedging through futures or options, LRP, livestock risk protection or livestock gross margin insurance products. But risk management becomes so much more than that. And there's an excellent visual, at least I think it's an excellent visual in the report that talks about risk management includes not just financial and market related risk management in that traditional sense, but it also includes production risk management. Do you have a generational transfer plan in place in your operation so that the next generations know exactly what their roles and responsibilities are? And have you built that transition plan with them in mind and what their goals are for the future of the operation? It also includes environmental risk management. Weather, obviously, and drought has been a chief concern of ours for a long time. But what are you doing in addition to that to control for disease or other related factors? Fire has been a big deal in obviously the West right now, and then just pests in general. North America is challenged with the New World screwworm cases in Mexico. Foot and mouth disease always has to be a concern. High path avian influenza on the dairy side. So environmental is really important. And then one that's becoming very apparent to us all right now is institutional risk. Obviously, regulations come to mind, environmental regulations, but also what's going on geopolitically, what's going on with trade wars, and how can that potentially affect us? And so thinking about risk management in a little bit broader sense, because as I mentioned, the total value that we're laying out for these animals today, whether it's a feedlot animal, whether it's a breeding animal, whether it's a calf on the ground that you're looking to grow and sell at weaning time, we've never seen values this high. And so fine-tuning those risk management plans and making sure that you're protecting the equity that you're building in your operation over the long run takes on an additional layer of importance at these record high prices.
Folks can take a look at your full report at the Rabobank website, rabobank.com. Always appreciate the time and insight. Senior Analyst, Animal Protein for Rabobank, Rabo Research, Lance Zimmerman. Good to catch up with you again, Lance, and we will talk to you soon.
Sounds fantastic. Thanks, Jesse.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.